Chapter 8 lecture focus on reporting and analyzing different types of receivables. So we explain how companies recognize account receivable, describe how companies value account receivable and record their disposition, explain how companies recognize, value, and dispose of notes receivable, and describe the statement presentation of receivables and the principle of receivable management. So you ready? Let's go. So what we have here are the definition of three different types of receivables. So I give you a hint. They are going to be other receivables, account receivable, and notes receivable. Not necessarily in that order. All right. So can you determine which term goes with which definition? The first one says amounts customers owe on account that result from the sale of goods and services. That would be, account receivable. A written promise, formal instrument for amount to be received, also called trade receivables, and that would be, notes receivable. And then the last group will be called non-trade receivables, such as interest, loans to officers, advance to employees, and income taxes refundable. This will qualify as being other receivables. So we're going to talk about these different types of receivables here in Chapter 8, beginning with accounts receivable. So when a service organization performs a service on account, it means the client has not yet paid them for those services. Or when a merchandising company sells a product or merchandise on account, once again, it means the client or the customer has not yet paid for those services. In each of these situations, we're going to recognize account receivable to show what is owed to the business organization. Now, the seller may offer a discount to encourage early payment. We'll look at what we call credit terms. The buyer may return goods found to be unacceptable. And we'll talk about what is the impact when a product that was sold has now been returned to the actual seller. We look at what's called a sales return account, and that's going to reduce the company's receivable. For example, I'm going to go old school. Assume that the Jordache Company on July 1st sells merchandise on account to Polo Company for $1,000. The terms are 2/10, N/30. You're asked to record this entry on July 1st. Well, to record the July 1st transaction, debit account receivable for the $1,000, the amount owed to the Jordache Company, and you're going to credit and recognize sales revenue. So again, debit account receivable, credit sales revenue in the amount of $1,000. On the 5th, the Polo Company returns merchandise worth $100 to the Jordache Company. So now a portion of what was sold on July 1st has now been returned on July 5th. So record the actual return. We have an account called Sales Returns Allowances, which is a contra revenue account. We're going to debit for the $100, and we're going to credit accounts receivable in the amount of $100. Okay? On July 11th, Jordache receives payment for the balance that's due. So remember back on July 1st, the sale took place for $1,000. The terms were 2/10, N/30. We had a return for $100 that took place on July 5th. So now the amount owed will only be $900, but because of the credit terms, we're going to receive a 2% discount if paid within 10 days. And yes, we did pay within the discount period. So when the payment is received, the amount of cash received will be the amount owed, the $900, but minus the 2% discount of $18. So we debit cash for $882. Recognize the sales discount for the $18, which is 2% of $900. Credit accounts receivable for the full amount of $1,900. So as an incentive, we gave the customer a discount of $18 for paying within the 10-day discount period. What that does for us, that is going to expedite or speed up the cash collection process. Okay? Now, some retailers issue their own credit cards. So assume that you use your JCPenney company credit card to purchase clothing with a sales price of $300. So for the actual merchant, they would debit account receivable for $300, credit sales revenue for $300. Now, of course, when you use credit cards, you must pay a finance fee, which is known as interest. And we're going to assume that with the JCPenney card, the interest is 1.5% of the balance due at the end of the month. So assuming the amount owed would be $300 at the end of the month, you take that times 1.5%, and they're going to recognize the account receivable of $450. For the interest, they're going to receive from the credit card transaction and record it as being interest revenue. So this is the transaction made by the JCPenney company. They're recording the actual sales on this transaction here. And here they're recognizing the interest they have earned by you using that JCPenney credit card, debit account receivable, recognized interest revenue. Okay? Let's go through a do it transaction. You want to do it? Okay. It says on May 1st, Wilton sold merchandise on account to Bates for $50,000. The terms are 3/15, net 45. On May 4th, there was a return of merchandise with a sales price of $2,000. Then on May 16th, we received payment from Bates for the balance due. All right. So on May 1st, we're going to first record the actual sales transaction. So we debit account receivable, credit sales revenue in the amount of $50,000. Then on May 4th, we record the return for the merchandise with a value of $2,000. You would debit the contra revenue account sales and allowances for $2,000 and credit account receivable for $2,000. Now at this point, the client only owes us $48,000. We're going to receive a 3% discount if paid within 15 days. Therefore, the amount of cash received will be the $48,000 less the 3% discount of $1,440. Recognize the sales discount, which is also a contra revenue account for the $1,440. Credit account receivable for $48,000. So these will be our entries to record the actual sale, to recognize the sales returns, and to show the amount of cash received from the actual client. Okay? Next up, how do we value accounts receivable? Two methods of accounting for uncollectible accounts. What's called the direct write-off method, as well as the allowance method. Okay? So when we talk about receivables, we understand that there's a risk that not all of our clients are going to pay us the full amount that they owe us. So we have to account for those amounts that we expect to become uncollectible. There are two approaches. One is called the direct write-off method. The other is known as the allowance method, and we'll go through both. With the direct write-off method, which is direct undesirable, we'll talk about that. There is no matching of revenues and expenses. Receivables are not stated at their net realizable value, and it's not acceptable for financial reporting. So we'll discuss why the approach is even an option. But with the allowance method, we spend most of our time here. The losses are estimated. It's a better matching of revenues and expenses. Receivables stay at their net realizable value. And this approach is required by GAAP. Meaning, if you are a public corporation, you must use the allowance approach in order to recognize your uncollectible accounts. Okay? Let's go through an example. So when it comes to a receivable, it is a current asset reported on the balance sheet. However, we understand that not all of our receivables will be collected all the time from all of our customers. We have what's known as uncollectible account receivable. Those are sales that were made on account that may not be collected. So we're saying is that, once again, when you allow your clients or customers to pay you over time, when you extend credit, understand as a business, you're not going to collect all the money owed to you all the time from all of your customers. Okay? We have to recognize what's known as bad debt expense. Bad debt expense. This is an expense resulting from the losses from extending credit to your customers. So again, understand that when you allow people to pay on credit, to pay over time, they're not going to pay the full amount owed to you all the time, and we have to recognize what's called bad debt expense. We'll also talk about how do I value account receivable. We'll discuss what is meant by this term, net realizable value. So here we have the account receivable account, and we have a new account title called the allowance for doubtful accounts. The allowance for doubtful account is a contra asset account. This account is used to represent that portion of our account receivables that we expect are going to become uncollectible. Now, the word contra means opposite or against. So on the actual balance sheet, we're going to show the account receivable count, but then less the allowance for doubtful account. So here you go, account receivable, $500, less the allowance for doubtful account of $25. So this $475 is known as the account receivable net realizable value. Again, this $475 is known as the account receivable net realizable value. What does that mean? We're saying that we know the clients owe us $500. We expect $25 to become uncollectible. Therefore, the net amount that we expect to receive from our customers equals $475. So the allowance account is shown deducted from account receivable on the actual balance sheet. An alternate way of showing it is just an account receivable net of the allowance and showing the $475. So you may see it in either format where it's listed this way, or you may see it listed in this format on the balance sheet of different companies. Okay, so we're going to come back and discuss more journal entries and transactions dealing with the accounts receivable account.